This is Mark Wilson. We're going to go through the Demonstrate Understanding of Company Financial Preparation, the Level 3 2022 exam. I'd like you to get out your resource booklet, open up to the first couple of pages, and we're going to adjust the trial balance. This is video 1. It'll take about 9 minutes. Video 2 will be doing question 1 and 2, and video 3 will be doing question 3. So grab a pen. I'm going to use a spreadsheet for this. You'll have to adjust on your page. This is where we're going to work through the additional information. Feel free to fast forward, rewind, stop, pause, play again to help understand what's going on. So the first one is interest on mortgage owing. You see here's the mortgage here, 5% for 5 years. Mortgage is $120,000. 5% of $120,000 is $6,000, and you can see we've only got $5,000 there. So on yours, you're going to cross out that $5,500 and write the new figure, which is $6,000, an increase of $500. So cross out your $5,500 and write $6,000, and that's called an accrued expense. An accrued expense is expense owing that does not include GST. You would have remembered that from level 1 if you did it. And just adding 500. Note down the bottom, my trial balance still balances, which is awesome. Cross number 1, put a cross through there so that you know that you've done it. Number 2, wages and salaries owing. So here's our wages and salaries. We need to add, cross the figure out on yours, and you're going to add 4,500. So you've got a new figure, 228,500, and that also is accrued expenses. We added 4,500 to this side. Must do the same here. So you've crossed out that 4,500 and 5,000, and we balance down the bottom. Put a line through that to show you finished. Number 3, the rafting revenue in advance, 32,200. So we've got income in advance, which is a liability. Write it in. And the figure is actually not the figure given. You've got to divide by 1.15 to write 28,000. I'd make sure I'd cross out the 32,200 up the top, just so that you make sure you don't put it in. The reason for this is that when we receive the money, that's when it's going to impact our GST, not when we've actually done the job. We've added it here, and it's for rafting revenue. You're going to take it off the rafting revenue. So cross out your 658,000, and you're going to minus your 28,000. You've got 630,000 still balance, and put a line through number 3. Number 4, we don't actually have to do anything. It's just telling us that the depreciation on plant and equipment is included in here, and accommodation and rafting expenses. So just put a line through number 4. Number 5, depreciation on buildings is 2,000. It hasn't been recorded, so we'll add those in. Building D, write it in on yours. Hope you can spell building better than I can. Well, still wrong. And we're going to put that on the credit side. Good. So we'll change that 10,000, cross out the 10,000 and write 12,000. Adding 2,000 to both sides. And rebalance. The next one also is around buildings. They're going to be revalued to the current valuation, 465,000. So the first step in doing this is we need to get rid of the accumulated depreciation. If it's going up in value, there'll be no accumulated depreciation. So we're going to get rid of the 12,000 there. So cross it out, make it 0. And over here, we're going to take it off the buildings figure. So again, cross out your 450,000. I'm going to minus 12,000 from it. That gives us 438, still balanced down the bottom. Now we're going to increase the value up to 465. 438 to 465, that's a $27,000 increase. Firstly, we're going to cross out your 438 that you've just written. You're going to write 465. And on the credit side, you're going to add it to the building revaluation surplus. So we're adding 27 to that. So we've got a gain here in the revaluation surplus. Balance down the bottom. Well done. The shares held for trading in RSL Limited, these ones, tells us the valuation's 80,000. At the current moment, it's 84. We need to take it down by 4,000. And that's an expense called decrease and shares held for trading. We've got an increase in expense and we've got a decrease to those shares. The reason why we do it in level 3 is because it's a current asset, and because we're intending as selling, it's good to have the current valuation there. Now the next ones here, number 9 and 10, 8, 9, 10, all relate to distribution. So what we're going to do is I would like you to write this underneath where you've got your additional information. I'm going to start from the bottom. I'm going to write the 31st of March. We had 200,000 shares. And the valuation of that was $458,000. Right, so write that on yours. Then go up, and on the 1st of July, 2021, try that again. Let's keep my alignment right. It tells us that we sold 20,000 shares. And the valuation for that is going to be 20,000 times $2.50 less the 4% brokerage fee. So get your calculator out, type in 20,000 times 2.5 times 96%, because that's what we get. And you find that figure's 48,000. And then we're going to go up to the 1st of April. And it means that how many shares do we have at the start of the year? So we'll need all these figures later on, so it's important you write them in. And if we go 458 minus your 48, the valuation of those shares or the contributed equity at the start was 410. So we're going to need that a little bit later on. That's all we have to do, really. So this information, you're going to use this now in question 1 and 2, which will be the next video.